Will WTI and Brent regain momentum in 2023 is the topic of discussion today. Oil prices have slumped since their peak in April 2023, which followed the production cuts announcement by OPEC+. The prices have retreated amid concerns of global recession and high interest rate environment and the concerns surrounding the US debt ceiling. The Brent crude oil price peaked at $86.96 on 12th April, had since then slumped to $74.03 on 9th June at 4:58 p.m. GMT-4. So many factors pulling the prices of the commodities in different directions. That's where we take a look at the oil prices forecast for 2023 and beyond. Let's look at the basics of the oil market first. In terms of density and sulfur content, West Texas Intermediate (W.T.I) and Brent crude oil are both high quality, light, sweet crude oils. In addition to being easier to distill, refine and transport, light oil, which is preferred by refiners. World oil markets are dominated by Brent and WTI. The North Sea is the source of Brent crude oil, while the US, primarily the state of Texas, is the source of WTI crude oil. WTI oil is typically cheaper than Brent crude despite having a lower sulfur content, as North Sea oil fields are depleted over time. Brent's key supply resources will be depleted as well. On the other hand, North America is increasing its production of WTI from shale and oil sands. WTI trades on the New York Mercantile Exchange, while Brent trades on the Intercontinental Exchange. Having seen the basics, now let's move to see how will oil prices in 2023 be influenced. As a result of the Russian invasion of Ukraine and the resulting restrictions on oil imports by Western countries, oil prices surged to over $130 per barrel in March 2022. The price of black gold has steadily declined since trading at elevated levels, and by 2022 it was trading at one-year low due to recession fears. Let's dwell a bit on oil sanctions against Russia. Over the past year, sanctions on Russian oil have dominated the oil market news. Russian crude oil imports were banned by the EU and the G7 in December 2022, along with the price cap of $60 per barrel. A refinery embargo was imposed in February 2023. Additionally, the G7, EU and partner countries have prohibited maritime services for Russian crude oil shipments and for Russian oil products unless the oil is purchased at or below a capped price. In spite of sanctions, Russia's seaborne exports have recovered as its trade has been redirected to non-sanctioning countries in Asia and Africa. Despite the sanctions, oil prices exhibited limited volatility. However, economists at the ECB believe there is still time for the effect to materialize. As sanctioning partners aim to keep the cap at least 5% below the market price of Russian oil, the price cap on crude oil may have a greater impact on Russian crude oil exports in the coming months. In response to sanctions, Russia announced a cut in oil production from March 2023, corresponding to around 0.5% of global crude oil supply, and the embargo on refined oil products may add additional pressure in the future. In the meanwhile, there is a reduced production by OPEC+. Oil production was unexpectedly cut by 1.6 million barrels per day by OPEC plus producers in early April. The cumulative reduction in oil output by OPEC plus, made up of OPEC, Russia and other allies, will be 3.6 million barrels per day, or 3.7% of the global oil demand. Oil prices have been supported by OPEC plus commitment to limit supply to support oil prices amid fears about global recession. Earlier this year, the International Agency of Energy released oil stocks which could also have triggered the crisis. Brent Crude rose over 6% following the announcement of reaching a high of $86.96 per barrel mid-April. Since 22nd May, the price has declined by over 12%. Oil prices have been affected by the concerns about the growth declines. The concern over persistent inflation, declining economic growth in the US, as well as anxiety about the banking sector and US debt default risks dampened investor confidence in oil. Despite falling US inventories, the demand forecast for crude remains weak. Crude oil momentum will be determined by how the US economy grows in the future. Increasing hawkishness in the Fed may boost the US dollar's momentum, sending WTI back to $68. Conversely, if traders perceive some weakness in the central bank's ability to maintain high rates through 2023, the dollar will likely reverse recent gains as risk appetite could push WTI back over $75 per barrel. However, the expectation is that oil remains range bound going forward despite the mixed signals, as we can put it. Air travel in China has returned to the pre-pandemic levels. Despite the lack of summer travel in the US, China's apparent oil demand grew by 50% to 14.5 MB per day, a record high in spite of industrial weakness. US oil inventories are being drawn down and distillate inventories are falling. Under the said circumstances, let's see the forecast of oil prices through 2023. The oil prices forecast for Brent crude was cut by bearish sentiments. In the first quarter of 2023, a barrel of the commodity traded at $82, rising to $84, $93 and $99 in the following quarters of the year and averaging to $90 by 15th May. Oil prices were predicted to trade at $89 in 2024 and $75 in 2025. OPEC's plus latest supply cut announcement has wiped out all of the gains made on the oil markets since the announcement. Rather, price action is being dictated by the macroeconomic factors. The outlook for the second half of 2023 remains constructive due to tighter fundamentals, even though there may be some downside in the near term. However, there are some aggressive expectations too by the market feelers. As per them, the Brent crude may trade anywhere between $90 to $105 per barrel by 2024. But I feel an average of $79 to $85 per barrel in the calendar year 2023 till December and around $74 in 2024. Of course, it is important to note that the predictions can go wrong. Always, we need to do our own research before doing any kind of trading. And never one should trade more than one can chew. And one should be prepared to lose while trading. With that caution, let me end by saying goodbye and thank you.